All right, welcome inside the studio. Today, what is your net worth? What does it mean? What does it mean to have a net worth that's positive versus negative, and how do you calculate it? This is just sort of a basic, if you want to figure out your financial position, debt, assets, liabilities, this is just the basics of what you need to know, okay? The general formula for net worth is quite simple. It is assets, and we will put assets over here on the left, assets minus liabilities. Quite straightforward. Things that you own with value minus your debt equals your net worth. And so we will do a sample sort of personal balance sheet here, and you will find that it is all really pretty easy to do. So first and foremost, you would figure out, well, what are my assets? What are the things I have that have value? So you might say, well, I have savings. That's my cash. Let's call it $5,000. And then I've got my 401k, and that has $15,000. And you might have, things that people have. You might have a stock and bond account that is separate from your 401k. We will just, pick nice round numbers, $10,000. And then you have CDs maybe, and the CDs are $5,000. And then, of course, we have real estate, and we'll deal with real estate in a moment. I might just put sort of like a little, just some dashes here, because there's two ways to handle real estate here, and we will get to that. The way I would typically, actually, do I even want to do it? Now, let's just do it the right way. Why do I need to give options? Let's just do it the right way. And then let's say you have a house. This is still 5,000. Let's say you have a house, and the house in the market is worth $300,000. But sir, what if you owe money on it? Well, we'll get to that. That would be a liability. And then you've got, crypto, which now is worth nothing. So we'll say $1,000. Great. So we can now calculate what are your total assets. This is 20, 30, 35, 335, 336. $336,000 is your total assets. Great. So now let's figure out our liabilities. What are liabilities? Well, liabilities would be, for example, a car loan. Kind of doesn't make sense to have a car loan but no car. So let's not do that. A car loan is a terrible example for this. Let's say student loan. Imagine that you have $12,000 of student loans. You have a credit card, and let's say there are $2,000 on your credit card. And then, yes, you have that mortgage, which is, of course, linked to this property. That's okay. And you owe $250,000 on the mortgage. Great. So we now know your total liabilities. Well, it's 14 plus 250. That's 264. So you have total liabilities of $264,000. Your net worth is simply the difference. That's 36 and 36. This means your net worth is $72,000. Your net worth is the value of your assets net of any liabilities. Okay. There are also other ways to sort of divide this that we could look at. And one of the things would be, what is your tangible versus intangible net worth? These are all tangible things in the sense that they are specific dollar amounts or real estate or whatever the case may be. There are other things that are intangible, which could be part of your net worth. That would include, like, for example, things are getting a little wacky here. Hold on. I want this to be just perfect for our audience. Okay. Intellectual property, right? So I don't know, like the David Pakman Show videos, they generate revenue, but by themselves, they have some value, at least in theory, for future monetization. You could have websites and patents and these types of things that can be hard to sort of evaluate. For business owners, one is like, what is the value of the business separate from the value of the business's assets, right? You've got the assets of the business. You've got the revenue stream. You might have intellectual property, but what is the book of business worth? And different industries, it would be calculated in different ways. You can have a negative net worth, certainly. Imagine that you had, imagine your student loan was 120,000. Then that would make your total liabilities 372, and then you would be negative. Okay, so you could certainly have a negative net worth. And then the other aspect of this that I do think is important is to consider whether the assets, whether you have realized some of these assets, and whether the way you put them on your balance sheet reflects the actual value once associated taxes have been paid. So let me see if I can kind of illuminate that for you. So imagine that you have stocks, and why are we getting that weird bar? Oh, I see why. There we go. Imagine that part of your net worth is your stock portfolio. And let's say that the value of that stock portfolio is $50,000. Great. You put it on your net worth as $50,000, right? Not everybody agrees with that. Why? Well, imagine that this 50K is from $10,000 of an original investment plus $40,000 in capital gains. That's how you've gotten to your $50,000. If you actually want the 50K for something, once you sell and realize these $40,000 in gains, you're going to have to pay some amount of tax. And so there's a perspective, certainly, that says, you really shouldn't have the stock at 50,000. You should have it at 10,000 plus the 40,000 minus your capital gains rate. And imagine that it's, long-term capital gains. I don't remember exactly what that is right now, but let's say that's 15%. That's $6,000, meaning really you should value this stock portfolio at 44, because that is what it is worth net of the taxes you would have to pay to get the money out. Most people I know don't do that. Similarly, imagine your house worth $350,000. Should you have it on the balance sheet at simply the value of the house minus the mortgage? I forget what the mortgage was that we made up, maybe 250. Well, there's an argument to be made that in order to convert, houses are relatively illiquid. Sure, you could get a loan against them, but if you actually want to sell the house, it takes some time. Realtors often charge 4 to 5% to sell the house. Depending on where you live, there may be transfer taxes. Sometimes they're called stamps, depending on where you live, and they could be, anywhere up to, I've seen anywhere from 0.5% up to 2% in different municipalities. There might be other expenses associated with selling. So should you really list the asset at 350, or should you list it as the net of these other things? It's really up to you. The question is, what is the purpose of the exercise? If a lender, for example, is evaluating your financial position, from what I understand, they're not usually going to go into this level of detail, including the costs to sell. If you are maintaining a spreadsheet of some kind, it's really just a personal decision. That's what it may be. So, but for the most part, I don't really know too many people that take out these sort of realization fees when they are thinking about their net worth. But it is certainly a personal decision. Lastly, one of the most important things to consider, and maybe we'll leave, this is so important, maybe we'll even do a new sheet here. There we go. Is what are the implications when you think about paying a debt or making an investment on your net worth? And this is really important to understand, because when we think about what is an interest rate, when we think about an interest rate, it is either what you are going to earn or what you are going to pay. And this is something that makes sense to consider. If you have a savings account at 2% and you have a credit card, if you have credit card debt at 15%, you have to think about this 15%, avoiding 15% by paying down the credit card debt is sort of like earning 15%. It really makes sense to think about it that way. And foregoing 2% interest on your savings account in order to buy, a depreciating asset, for example, is sort of like paying a 2% interest rate. So sometimes people will, we're going to do a separate video on should you pay off your mortgage. You could have a situation where people say, well, I have a mortgage, and I continue to apologize about my handwriting, although it's a little bit better today. I have a mortgage at 4.25%. Should I pay it off early or should I do something else with the money? Well, the question is, what else is it that you're going to do? Are you going to put it in savings at 2%? And it's really, what are you actually going to do? Because a lot of times people say, well, I've got this mortgage at 4.25, but the market over a long period of time returns 7%. Great. Is your asset allocation, check my asset allocation video, is your asset allocation such that if you were not putting the money into the mortgage, you actually would put it in the market? Or is that not actually the asset allocation that you've determined? And so this question of, well, I can avoid 4.25% by dumping money into my mortgage, or I could potentially earn 2 or maybe 7%, or maybe if I invest in a business or whatever, I could earn an additional amount. Two things that are important to consider. One, will you actually put the money into that other thing? And does that align with your asset allocation? But then the second part is it guaranteed? And is it guaranteed over the same period of time that you will have the mortgage? This right here, the 4.25, assuming it's fixed, is fixed. It's a known entity. Savings might be 2% now. If rates go up, it could be higher. If rates go down, it could be lower. The market might return 7% over long periods of time, but over the next, imagine you have 12 years left on your mortgage. Over the next 12 years, the market might return minus 2% a year, or it might return 20% a year. You don't know. So there's a psychological question as well as to what is the weight of the mortgage on you relative to the certainty of the return that you would achieve in a different asset class. That's way off from net worth. But the most important thing, net worth, we'll stick it back up here. Assets minus liabilities equals net worth. Thank you very much.